So what I wanted to do here today is take you through a fairly high level concept of how we can use permanent life insurance as an alternative asset class for high net worth individuals and those with a significant amount of money invested in either a registered fund, a real estate, or taxable dividends at the time of death. Now, you've worked hard for your money throughout your lifetime. Investing your excess cash flow can have unintended consequences when it comes to taxation on your estate. A permanent whole life insurance policy can be viewed as an alternative asset class that can provide benefits during your lifetime, but may also leave a larger estate for your loved ones. Assuming a conservative investment profile with a return of around 3%, a marginal tax rate of about 53%, and a life expectancy of age 90, this slide shows how an investment of $150,000 compares to a life insurance policy with a premium of $25,000 over 6 years. 25,000 times 6 is $150,000, so it's the same amount of money spent. The top line shows the value of the life insurance policy at age 90. Now this is if you took the policy out at age 60, I believe. The taxable investment or the value of a investment after tax is the second line. The third line is the value of that same investment before tax, and the bottom line is the amount of money that has been contributed over the 6-year period. This slide shows the way investments are taxed. So you have your payment that goes in at the top into a non-registered investment. On the right, it shows that that is now taxed annually on growth. When you die, the value is taxed again on unrealized gains. It's one of the only times within the Canadian tax code that the same dollar, potentially, is taxed twice. By way of comparison, a life insurance policy receives your payment into the policy contract. There is no tax on growth, and when you die, there is no tax on the death benefit. This means, by way of comparison, to obtain a value of $375,000 on your passing, in the life insurance on the left there, we put in $150,000. You need to put in around $250,000 to get the same value on an interest-bearing investment. A little bit less on dividends, and a little bit less again if you're making your money through capital gains. We can do this same slide as a percentage. The rate of return on the average life insurance policy is around 3.5%. You would require a rate of return of over 7 in an investment account, a little bit less in dividends, and again a little bit less in capital gains to achieve the same after-tax benefit of $365,000. Now the question arises, when you're putting money into a life insurance policy, how do we access those funds during our lifetime? Now, if you own a corporation and this money is run through a corporation, that is relatively easy to do, provided you can find a bank that is willing to play ball. So again, just to reiterate, we're looking for a payout in about 30 years. So you can see here, this slide shows that over the period of about 30 years, on an investment of $300,000 and some odd, about $200,000 is lost to tax on your death. But by using a life insurance policy, we can access that cash in a more tax efficient manner. Now, this is a busy diagram. but it shows how to use life insurance as a collateral loan, as collateral for a line of credit, and provide a stream of income back to the shareholder and avoid tax on passive income in the corporation. So we take capital in a taxable investment, this is the top left of the screen, put it into a tax-advantaged life insurance policy, and that stops the passive income tax cold. Eventually we have enough cash value in the policy that we can assign it to the bank. The bank will provide a tax-free loan to the corporation, which will then pay to the shareholder as either a dividend or salary and be taxed accordingly. The result being that when your corporation buys a life insurance and names itself as the beneficiary, this opens up new opportunities for the capital dividend account. By using a personal loan, it is arranged with the lender for the corporation to receive the death benefit. The corporation pays a tax-free capital dividend to the estate repays the loan, and the full credit to the capital dividend account is the death benefit minus any adjusted cost base of the insurance policy. The chart shows how this works versus cash invested. So cash invested of $150,000 or life insurance premium of $150,000 creates net cash flow to the shareholders of about either $119,000 in the case of cash, or $140,000 in the case of life insurance. The net death benefit after a loan is repaid, of course, would be zero, because there's no loan to worry about in terms of cash, or $106,000 in the event of life insurance. But the credit to the capital dividend account is also zero in cash, or $378,000 in the case of life insurance. Net benefit to the shareholder estate, $106,000 in the case of life insurance, zero in the case of investments. Net benefit to the shareholder's estate of $142,000 again in the case of cash, or $378,000 in the case of life insurance. Again, we're back to the tax advantage of life insurance versus various investments. For a potential capital required to achieve that $375,000 dividend. Again, in life insurance, we're looking at $150,000. With the investment, dividend, and capital gains options, we are looking at significantly more money. And again, the percentage of things when we look at it in terms of the percentage to produce the same cash flow and net estate value as life insurance, other asset classes may require significantly more capital or higher rates of return. So again, this is a fairly high level concept. I did not go into a lot of detail in terms of the tax calculations. The purpose is just to kind of show you how life insurance can behave as an asset class when you're dealing with large amounts of taxable assets in your estate. This is something to consider if you are expecting to die with registered money, RRSPs, RIFs, etc., or capital gains on real estate that you are not going to sell prior to your passing, other than your primary residence. But if you're investing in real estate, or you have vacation properties, that kind of thing that you want to keep in the family, this would be a great way to offset the capital gains that are payable on that. Or if you have a significant amount of money in a Canadian-controlled corporation that is going to create tax when you try to transfer those shares to another individual. This is essentially what we talk about when we talk about deemed disposition on an estate. The government deems that you have sold all of your assets 1 second before you die. Those assets, or the value of those assets, is then brought into your estate and taxed as income in your final year of life. If you have a life insurance policy that pays out an equivalent amount or a similar amount at the same time, then you're offsetting the amount of tax that's payable. And then, of course, accessing that cash in your lifetime is also a possibility, as I've laid out here. So if you are in that situation, the question I often ask is, do you expect an estate of greater than $100,000 in registered money when you pass away? Then this may be a concept that is worth a closer look. So feel free to reach out, and we'll take it from there. Thank you.